Journal entries are the backbone of financial record keeping, capturing every transaction with clarity and accuracy. Understanding how to document them properly ensures better financial management and informed decision making. Let's dive into the essentials of financial document journal entries. Understanding financial documents. The ultimate trick for perfect journal entries every time. By Easy Peasy Accounting. Introduction to financial documents. What are financial documents? Defining financial documents. Financial documents are records summarizing a company's financial activities and position. They are essential for tracking income, expenses, and overall financial health in business. Importance of financial documents. Financial documents help track income and expenses, ensuring smart financial decisions. They provide legal protection, transparency, and support compliance with regulations. Additionally, they are crucial for budgeting, securing loans, and forecasting future financial stability. Types of financial documents. Invoices, checks, and credit notes help to accurately document every incoming and outgoing transaction for meticulous bookkeeping and comprehensive business oversight. Overview of key documents. Checks. A check is written with instructions to a bank to transfer money from one account to another. It includes both received and paid checks, ensuring secure payments. Credit notes. Documents issued to correct errors in invoices or to provide refunds. Includes two types. Credit notes issued for sales and credit notes received for purchases. Invoices. Detailed bills for goods or services provided, specifying amounts owed and payment terms. Includes two types. Sales invoice and purchase invoice. Understanding invoices. We have two types of invoices, sales invoice and purchase invoice. Sale invoice means you sell something to your customers and issue an invoice for him. Definition of sale invoice: a bill issued by a seller to a customer, detailing the goods or services sold, the price, and payment terms, confirms revenue for the seller. Purchase invoice means you buy something from a seller and the seller issued you an invoice. Definition of purchase invoice: a bill received by a buyer from a vendor or supplier, detailing the goods or services purchased, the price, and payment terms, confirms expense for the buyer. A brief guide to help you grasp the accounts involved in sales and purchase invoices for journal entries. Sale invoice. When you sell to a customer, they either pay in cash immediately or settle the payment at a later time. The accounts associated with customers' transactions and sales include cash or accounts receivable debit, sales discount, debit, sale revenue, credit, tax charged on sale, credit. Unlocking the mystery: why sale discounts are a debit. Revenues are recorded as a credit account. Since sales returns and discounts reduce revenue, they are considered contra accounts and are recorded as debits. Purchase invoice. When you purchase from a seller, you either pay in cash immediately or settle the payment at a later time. The accounts associated with sellers' transactions and purchases include purchase expense, debit, tax paid on purchase, debit, cash or accounts payable, credit, purchase discount, credit. Unlocking the mystery: Why purchase discount credit? Expenses are recorded as a debit account. Since purchase returns and discounts lower the total purchase expense, they are considered contra accounts and are recorded as credits. Scenario: you are working at Alice Store. The company name at the top of an invoice, credit note, or check is called the issuer or billing entity. When Alice Store issues an invoice with its name at the top, it means the store is selling something. This is a sales invoice. However, if Alice Store buys from Gaia Wholesale, the invoice they receive will have Gaia Wholesale at the top. This shows Alice Store is the buyer, making it a purchase invoice, not a sales invoice from Alice Store. Sale invoice example. Sale invoice issued by Alice Store. The customer pays in cash immediately. The subtotal of the invoice before tax is $2,300, which is recorded as sale revenue. The total amount due, $2,195, reflects the cash payment made by the customer, as the payment method is immediate cash. Accounting entries for sale invoice pay in cash immediately will be: cash, debit, $2,195. Sales discount, debit, $230. Sale revenue, credit, $2,300. Tax charged on sale, credit, $125. Example: sale invoice issued by Alice Store. The customer pays later. Accounting entries for sale invoice pay later will be: account receivable, debit, $2,195. Sales discount, debit, $230. Sale revenue, credit, $2,300. Tax charged on sale, credit, $125. Purchase invoice example. Alice Store purchased from Gaia Wholesale. The term is paid in cash immediately. This is a purchase for Alice Store. The subtotal of the invoice before tax is $5,000, which is recorded as purchase expense. The total amount due, $4,625, reflects the cash payment made by Alice Store, as the payment method is immediate cash. Accounting entries for purchase invoice pay in cash immediately. Purchase expense, debit, $5,000. Tax paid on purchase, debit, $125. Cash, credit, $4,625. Purchase discount, credit, $500. Example: Alice Store purchased from Gaia Wholesale. The term is pay later. Accounting entries for purchase invoice, pay later. Purchase expense, debit, $5,000. Tax paid on purchase, debit, $125. Accounts payable, credit, $4,625. Purchase discount, credit, $500. Understanding checks. Types of checks. Check received from customers. A check received as payment from a customer for a previous sale indicates payment received. Check paid to vendors. A check issued as payment to a vendor or supplier for a previous purchase indicates payment made. Accounting entries for check received from customers. Cash debit. Sales discount debit. Accounts receivable credit. For example, a check was received from Sophie's Fashion as payment for a previous invoice. The check amount is $1,020, reflecting a sales discount of $50 from the original total of $1,070, which includes $70 in taxes. The initial journal entry was recorded on the date of the sale when the invoice was issued. Accounts receivable, debit, $1,070. Sale revenue, credit, $1,000. Tax charged on sale, credit, $70. Journal entry recorded on the date the customer's check was received. Cash, debit, $1,020. Sales discount, debit, $50. Accounts receivable, credit, $1,070. Accounting entries for check paid. Accounts payable, debit. Cash, credit. Purchase discount, credit. For example, Alice Store makes a payment of $510 to its supplier for a previous purchase invoice, reflecting a $25 purchase discount. The original amount was $500, with an additional $35 in taxes. The initial journal entry was recorded on the date of the sale when the purchase invoice was issued. Purchase expense, debit, $500. Tax paid on purchase, debit, $35. Accounts payable, credit, $535. Journal entry recorded on the date the check payment was made. Accounts payable, debit, $535. Cash, credit, $510. Purchase discount, credit, $25. Understanding credit notes. Types of credit notes. Credit note issued on sale. A credit note is issued for a sale when a product is returned or a customer receives a credit adjustment. It serves as a document from the seller to correct an error or process a refund for the customer. Credit note received on purchase. A document received from a supplier when a purchased product is returned or credit is granted, serving to correct an error or issue a refund to the buyer. Credit note issued on sale for customer. Accounting entries for credit note issued. Sales returns and allowances, debit. Tax charged on sale, debit. Cash or accounts receivable, credit. For example, Alice Store issued a credit note to a customer detailing the subtotal $200, applicable tax $14, and the total amount after tax adjustment $214. The initial journal entry was recorded on the date of the sale when the invoice was issued. Cash or accounts receivable, debit, $214. Sale revenue, credit, $200. Tax charged on sale, credit, $14. Journal entry recorded on the date the credit note was issued. Sales returns and allowances, debit, $200. Tax charged on sale, debit, $14. Cash or accounts receivable, credit, $214. Credit note received on purchase. Accounting entries for credit note received. Cash or accounts payable, debit. Purchase returns and allowances, credit. Tax paid on purchase, credit. For example, Alice Store received a credit note issued by the supplier Gaia Wholesale, specifying a subtotal of $200, an applicable tax of $14, and a total amount of $214 after tax adjustment. The initial journal entry was recorded on the date of the sale when the purchase invoice was issued. Purchase expense, debit, $200. Tax paid on purchase, debit, $14. Cash or accounts payable, credit, $214. Journal entry recorded on the date the credit note was issued. Cash or accounts payable, debit, $214. Purchase returns and allowances, credit, $200. Tax paid on purchase, credit, $14. Understanding financial document journal entries is key to maintaining clear and accurate records. Keep tracking, keep learning, and keep growing your financial expertise. Thank you for watching. If you enjoyed this video, don't forget to hit that like button. It really helps the channel grow. Share this with your friends who might love this too. And if you haven't already, subscribe and turn on notifications so you never miss out on exciting new content. Your support means the world to me, and I can't wait to keep bringing you more.